You ever stop and think about what really holds our huge public stock markets together? I mean, it's not just big ideas and ambition, right? Nope. It's actually a super complex system of rules, and it's all built on one single powerful idea: trust. So let's pull back the curtain and look at the hidden architecture that turns a company's promise into cold, hard cash.
I mean, really, think about it for a second. Why would you or anyone trade your actual hard-earned money for what is basically a piece of paper, a digital certificate? It's just a promise, a claim on a company's future profits. That's a massive leap of faith when you think about it.
And that leap of faith has a name. It's called equity financing. It's a simple trade-off, right? A company gets the capital it needs to build new factories or develop new tech, and in return, investors get a little slice of the company, hoping that those uncertain future cash flows become very, very certain profits. But this simple idea creates a huge problem.
And that problem is what we call the public trust problem. See, the company insiders, they know everything. They know the real numbers, the real risks, where all the bodies are buried. But you, the investor, you only know what the company decides to tell you. It's kind of like buying a used car, right? The seller knows every little quirk and problem, but all you see is a shiny new paint job. That gap in knowledge is a recipe for disaster, and it's where trust can just completely fall apart.
So how do you fix a problem like that? Well, the answer is a system of regulation. Now, let's be super clear. The goal of these rules isn't for the government to pick winners and losers or to tell you, hey, buy this stock. Not at all. The entire point is to create a system that forces companies to tell the truth, to tell the whole truth, and to do it in a way that's standardized so you can actually compare one company to another. When you boil it all down, this system is really built on 4 big pillars. First, you've got full and fair disclosure. You have to know what you're buying. Second is market integrity, which just means no cheating, no manipulating the system. Third is investor protection. If a company lies, there have to be consequences. And finally, and this one's key, ongoing transparency. This isn't a one-time thing. It is a lifelong commitment to being honest.
Okay, so that's the why behind all these rules. But what does it actually look like? How does it work in the real world? Well, we can think of it like a journey, a kind of life cycle that every company goes through on its way to the public market. You can basically break this journey into 3 main stages. First, before they can sell a single share, the company has to do a ton of homework, creating its key documents and getting the official green light. Then, during the offering, there are super strict rules about how they can market and sell the stock. And then, stage 3, after they're on the stock exchange, well, that's when the real work starts. That's the lifelong commitment to telling everyone everything important all the time.
Now, the absolute centerpiece of this whole process is a document called the prospectus. You can think of it as the company's entire life story, but told under oath. It's the official selling document, and it has to be given to anyone who's even offered a share. Inside, the company has to lay it all out there, exactly how the business makes money, its financials, every single risk you can imagine, and a detailed list of who exactly is running the show.
And here's what's really fascinating. This basic logic, this idea of forced transparency, it is not just a US thing. It's a global standard. And to see just how universal it is, let's compare 2 totally different systems that are actually built on the exact same idea: the United States and Mexico. So up in the US, the top cop on the beat is the Securities and Exchange Commission, or the SEC. And the big document for a company going public is called a Form S-1. Then you hop down to Mexico. The regulator there is the CNBV, and their whole system is built around a foundational law called the Ley del Mercado de Valores, or LMV for short. And seeing the actual document really drives the point home, doesn't it? This is the legal backbone for all of Mexico's public markets. Sure, the language is different, the specific articles are different, but its core mission? It's exactly the same as the laws in the US. Create a fair, transparent market where people can feel safe investing their money.
So you see the pattern here, right? You've got different names, different government agencies, different legal books, but the underlying logic is identical. 1, tell people what they need to know. 2, put it in a standard format so it's easy to understand. And 3, if you lie, you're going to be held responsible. It's that simple.
Okay, so it's one thing to have all these rules on the books, but so what? Do they actually have any teeth? Do they really matter? Oh, you bet they do. Let's talk about the very real consequences that happen when these rules are followed and when they're not.
You have to understand, regulators are in a constant battle against these four horsemen of the financial apocalypse. That information gap between insiders and the public, companies putting out flat-out misleading information, shady corporate governance where execs are just lining their own pockets, and, of course, straight-up market manipulation. These rules are the firewall against all that chaos.
And if you want a perfect, real-world example of that firewall in action, look no further than this. This quote is about the Mexican stock exchange hitting the pause button, suspending all trading for a massive company, Grupo Electra.
And why did they do it? Well, the company, allegedly, failed to meet the bare minimum requirements to even be listed on the exchange. This is so important because it proves that going public isn't the finish line. It's the starting gun for a permanent race of transparency. An action like this sends a shockwave through the market, reminding everyone that the rules are not optional.
So, as we bring it all home, let's just boil this all down to the key ideas. Because going public, this whole equity financing thing, it is so much more than just selling some shares to raise cash.
If you're going to remember anything from this, remember this. First, when a company goes public, it is signing up for a permanent commitment to tell the truth. Second, the whole point of that is to build trust, which is what allows markets to work smoothly and for stocks to be priced fairly. Third, what happens after a company goes public is just as important as what happens before. And finally, these rules are not suggestions. They have real teeth, and regulators will use them.
So I'll leave you with this final thought to chew on. If you were running a company, which do you think is actually riskier? Taking on a huge loan from a bank with all the strict rules and contracts that come with it? Or accepting the never-ending, permanent obligation of being completely transparent to the entire world? It's a pretty interesting question about risk and trust, isn't it? Something to think about.